In the digital age, one invention stands tall, reshaping the global economy: Bitcoin. Born out of an anonymous white paper in 2009, this digital currency has challenged our traditional understanding of money. Instead of relying on central banks and governments, Bitcoin operates on a decentralized network, putting the power back into the hands of the people. It's like a financial rebellion, sparking a wave of cryptocurrencies and inspiring a shift towards a digital economy. Bitcoin's impact on the global economy is undeniable. It has transformed the way we view, save, and transact money. From the bustling streets of Tokyo to the serene landscapes of Scandinavia, Bitcoin is making waves, breaking barriers, and rewriting the rules. As we navigate this new financial frontier, one key aspect to understand is the concept of Bitcoin halving. Bitcoin halving, a term that might seem complex but is a fundamental part of Bitcoin's design. Picture this: you're a Bitcoin miner, hard at work verifying transactions and creating new blocks. Suddenly, your reward for this labor drops by half. This is Bitcoin halving in action. Now you might wonder, why does this happen? Well, it's all part of Bitcoin's ingenious design. Approximately every 4 years, the reward for mining new blocks is halved. This means that miners receive 50% fewer Bitcoins for verifying transactions. It's like a digital gold rush that gets tougher over time. This clever mechanism ensures the longevity of Bitcoin by controlling the rate at which new Bitcoins are created. It's a balancing act, keeping Bitcoin supply in check and maintaining its value. That's Bitcoin halving in a nutshell, but why does it matter? Bitcoin halving is not just a process, it's an event with significant implications. Imagine a gold mine that suddenly, every 4 years, starts producing half the amount of gold it used to. That's essentially what happens with Bitcoin during a halving event. The halving process directly impacts the supply of Bitcoin, slowing down the rate at which new Bitcoins are created. It's a bit like putting a brake on the overall production. This is important because it ensures that the total number of Bitcoins in existence will never exceed 21 million, a limit set by Bitcoin's creator. Now, if we consider the basic market principle of supply and demand, when supply decreases and demand remains the same or increases, the price tends to rise. So, potentially, as the rate of new Bitcoin creation decreases, we could see an increase in Bitcoin's value. So, as we see, Bitcoin halving impacts the rate of new Bitcoin creation, potentially influencing its value. To wrap it all up, let's summarize the key points. We've delved into the Bitcoin revolution and the intriguing concept of Bitcoin halving. This is a process that cuts the reward for mining new blocks in half every 4 years. It's a kind of digital austerity measure built into the very code of Bitcoin to control inflation and maintain the cryptocurrency's value. What does this mean for Bitcoin? Well, with halving, the production rate of Bitcoin slows down. This can potentially lead to an increase in demand for the cryptocurrency, especially if its use continues to grow at its current rate. With less Bitcoin being produced and more people wanting to get their hands on it, the value of Bitcoin could potentially increase. Bitcoin continues to revolutionize the global economy, and understanding concepts like Bitcoin halving helps us navigate this exciting new frontier.